Well, if you have seen on social media or someone in real estate has told you that mortgage rates just dropped this past week by 25 basis points, unfortunately, that is just not true. Fortunately, though, they actually already did a few weeks ago, and let me explain. We did see the Fed decide to cut interest rates by 25 basis points this past week on September 17th, which was great news. Another, once again, long anticipated rate cut that the market has just been screaming and wanting for really the past year and a half. But why then did rates not drastically drop, or why did they even actually go up a little bit? Well, the answer is pretty simple. It's because when the news of these cuts happen, typically the market already reacts beforehand. And that's why we saw over the past 3 or 4 weeks, rates begin to steadily drop to the lowest levels we've seen in over a year. So much so that it's created a refinance opportunity for a lot of clients, residential, even on the commercial side, and even on the non-QM world. So what's the real impact for when the Fed's going to lower rates? Well, you need to watch a couple things. The next several meetings from October to the end of the year in Q4 2025 will determine if they're going to continue to cut. So we really already saw the impact of this past cut ahead of it. The question is, will they continue to do it in Q4 of 2025 and even into the end of Q1 in 2026? If they do continue to cut rates at that steady drip, the way that it's rumored and expected that they're going to, we're going to see significant drops in the interest rate market on the mortgage side steadily, and hopefully what will be a stabilized drop, meaning that they're going to stay there for a while, little by little. So keep an eye out for not necessarily what just happened and where the rates are at today, but what will happen over the next several months and into the beginning of 2026. That's going to tell you the real story of where rates are going to stay. One of the questions that keeps coming up again and again in this market is, when is affordability going to get better? And with what is happening with interest rates, hopefully even over the next few months and quarters, is it really going to help stimulate the market? Are we going to see the market get back to normalcy? Well, there's a few things to consider. Each time that the market does drop and actual mortgage rates drop by 0.25%, about 78 million people apply for a mortgage, whether it's they're trying to purchase their home or they're trying to refinance. You have a lot of mortgage applications flooding the market. And even in the past 4 or 5 weeks, the average buyer in my market has increased their buying power by about $75,000, which is huge. That means that might be the difference between whether or not they actually won the bid on that home. If they couldn't go as high as they wanted to 6 months ago, there's an opportunity to do that now. I have been in the real estate finance, mortgage, and investing world for 14 years. I own several hundred units as a real estate investor, flip properties, consulted on them, and I run lending here at a national bank. And so I've seen the residential, the commercial side of it, and looking at this market now, I see affordability increasing, but I also see the competition increasing. Now, as an investor, what this means is very interesting for us who are investors, okay? With rates dropping down, typically that means increased cash flow, right? That means that your deal just got stronger. That means you're spending less money on the deal. That means if it's stabilized, that your cash flow is typically increased. One of the interesting points that we're at in this axis is that values are remaining high, but interest rates are starting to drop, okay? So as an investor, we have an opportunity here, and we don't know how long that's going to be, but it's to capitalize on the equity that we've got stored in properties. And by capitalize, I mean very, very carefully, and that's the key word here, right? Carefully leveraging the equity that you have to capitalize on what the next investment play might be. I can tell you what I am focused on, and that is capitalizing on cash flow assets. You need to be really careful in a market where the appreciation and the equity is constantly increasing. I have seen many investors, whether they have a handful of properties or a lot more of them, just trust in the increase of equity. They over leverage themselves, and they have all of these properties that they need to sell, which is an appreciation play at the end of the day. And they don't have anything that's actually stabilized and cash flowing recurring. And so what I'm focused on is taking the increased equity, leveraging that very, very carefully, and putting that into assets that are going to cash flow for the long term, because this market will correct. there will be a competition. The residential market will surge. We will see that, I truly believe, in 2026. But eventually this market will correct, and we're looking years down the line. And it may take you a year or two to even stabilize an asset, but if it's an appreciation play, if it's a sell-off play where you're banking on demand, this market will adjust, especially in certain areas of the country and in certain even clumps of the Northeast where I'm in, where there's a lot of concentration. So again, what are we doing? I'm focused on putting those available capital funds into cash flowing properties. Why? Because in the event of a market correction and an adjustment, one thing that'll always keep a property valuable is stabilization and cash flow. So as an investor, if there are investors out there or real estate agents or those of you who are working with them, I would encourage you to look at your portfolio or what you've got going on in the market as a whole to say, is there an opportunity to very carefully leverage the equity that I have? And what should I be investing into that? Well, I would be investing into assets that are going to be cash flowing, recurring, rental properties, ones that have a strong, in a market with a lot of strong demand for the type of rental that you have, because that's what will keep that portfolio strong in the event of a market correction. So let's use the increased equity while we have it, but put it into plays that are going to keep your asset stable for a longer period of time as this market adjusts over the next couple of years. All right, if you are a real estate agent or a loan officer, or especially someone who is looking to purchase more real estate, an investor, and you're looking for other ways to do it, maybe you're tapped out on the type of loans you have, you're looking for other ways to work with capital, this is really for you. I've been in the real estate market for 14 years as an investor with a few hundred units, flipping properties. I've been in the residential and the commercial side of the mortgage business and now run lending at a national bank. And I can tell you that there's several products that are coming into the market by storm that are all the rage right now that are really going to be impactful for those who are looking to continue to invest in real estate, regardless of what this market does as it goes up and then more than likely corrects over the next couple of years. So if you're any in those categories, listen up, this is for you. We're seeing non-QM products are taking the market by storm right now. A non-QM means they're not traditional FHA, they're not conventional, you're not your VA, USDA, they're private sector mortgages essentially that are based off of some non-traditional types of credits, types of incomes, and so on and so forth, originally for self-employed folks, for investors, but they have evolved so much over the past few years that many studies lead to the conclusion that they're going to be about 30% of the market. So if you're a loan officer out there and you say, I don't like non-QM, you better start to like it, because it's going to be almost a third of the market in more than likely about 2 years. And even today, the demand for this product and the amount of loan originators and the amount of mortgage companies out there who are actually taking these loans on, this market is about 70% underserved. So 70% underserved, and it'll be about a third of the market in 2 years. Something to pay attention for if you want to do more business now and into the next few years. Why are they growing? Why is there such a demand? Because if you've gotten multiple mortgages, or if you've been an investor, if you're a real estate agent and you've worked with them, you know that after some point, you just kind of max out on the traditional mortgages out there. You just can only afford so much on paper, on your tax returns, or the W-2 income you have. And sometimes the cash flow and the actual income from these other investments doesn't really show and isn't calculated the way it actually impacts your financial world on a day-to-day basis. And so you don't have the ability to get more than just a few traditional loans, right? So that's where non-QM bridges the gap, especially for those who are self-employed, even for those who have multiple properties and have invested in a lot of properties. You're taking all your write-offs and you need something that's going to consider the cash flow of the property rather just what's on paper. That's what these products do. Again, they're greatly increasing in demand. Rates have also dropped on them. Traditionally, they were sometimes 1 to 2% higher than your traditional mortgage loans. But now they have adjusted so much, the market has adjusted for them. They're getting more and more competitive to where we're seeing rates in the mid to high sixes. Yes, in the mid to high sixes for non-QM loans, which is very, very close to your traditional Fannie Freddie loans that are out there for conventional mortgages. So one of the other products that is increasingly coming into the market, and this is really important to keep your eye on, especially if you're an investor with a lot of equity in properties that you have that's untapped, is AI-driven second mortgage. And I think it is long overdue, and I'm really excited that companies are starting to innovate and create lending products for the consumer out there, whether you are trying to buy your second home or your 20th investment property. We're seeing the rise of the AI-driven, data-driven second mortgage. And these are HELOCs that you can get on not just a primary residence. Traditionally, HELOCs and second mortgages were something that they only wanted on a primary residence, maybe a second home, but certainly not an investment property for the most part. And then after COVID, 2020, 2021, and at the end of the market in 2022, most banks pulled heavily back on second mortgages and HELOCs because, again, a second mortgage is, right, you're not in first position, so it's a riskier loan for a bank. But now we're seeing them come back to the marketplace and on a much more data-driven basis. So traditionally, you have to have a very high credit score to get these mortgages, and you can only put them on a primary residence. Well, as interest rates come down and there's an opportunity to refinance, consolidate debt, but equity remains high. Again, if you're an investor and you have equity that's untapped, this could be a really good play for you to free up some capital if you're looking to acquire more real estate or do whatever you want essentially with the cash. So we're seeing these types of mortgages right now. Our team does them. It's a new product launch that we just did, and it's incredible the innovation that has been done on these. This new product, it's a fixed rate. You can have them on second homes, primary residence, and even investment properties that you own. And there's not even an appraisal needed if you draw less than $400,000, which is just incredible. We can even close them in as fast as 5 days, and that's legitimate. Why? Because it is a data-driven approval and not necessarily the traditional manual underwriting type of approval. So as fast as a 5-day closing, no appraisal needed under $400,000. All right. So again, whether you're looking to purchase more properties for buying your beach home or some vacation home, buying another primary residence, you're moving, or increasing your real estate portfolio, there is capital available. And this is why I'm letting you know. So if you need this product, you can get a hold of it, and we can certainly help you with that.